almost nothing you can do about it with the exception of your primary residence. That's a tax number one. Tax number two. My name's Dustin McFarland. Thanks for tuning in. I love talking about this stuff. This just makes me happy. The next tax we want to talk about is capital gains tax. Capital gains is calculated when you look at what you paid for the property against what you sell the property for. So if you buy a property for $100,000 and you sell that same property for $1 million, your gain on the property is $900,000 that gets taxed depending on how long you own the property, but roughly at 20%. California treats it as ordinary income, so that's just California, whatever your tax rate is, call it 10%. So 20% and 10%, you're going to pay a 30% tax on that $90,000. So if you buy a property for $100,000, you sell the property for $900,000, for $1 million, that's a $900,000 gain. Your tax is going to be $300,000. There's just really not a good way around it. However, there's some exceptions, and they call them exclusions. So the first one is if this is your primary residence. If it's your primary residence, then you've lived in that house for 2 out of the last 5 years, they're going to give you, if you're single, and you and your spouse, if you're married, a $250,000 exclusion on the gain. So that means that if I'm single, the first $250,000 of gain doesn't count. And if I'm married, then the first $500,000 of gain doesn't count. So on my example, you buy a house for $100,000, I'm married, so I get another $500,000 of exclusion. So now I'm up to $6,000. I sell the property for $1 million. That means $400,000 is going to be taxed. And I would much rather pay 30% of $400,000 than 30% of $900,000. You've got to understand, though, that the $250,000 and $500,000, this is really just applicable in primary residences. If it's an investment property, or worse, and this is really a problem, if you move out and you're living with one of your kids, or you're living in an assisted living facility for 2 or 3 or 4 years, and you haven't lived in that home 2 out of the last 5 years, then you might not get the exclusion. You might have given it up because you've been out of the property for so long, it's no longer your primary residence. So be really careful when you move out, when you think you might sell a property. That exclusion is worth a lot of money, and we want to make sure you can use it if possible. So the capital gain is calculated based on how much you sell the property for. If you want to put your kid's name on the deed, which I think is a terrible idea for a lot of reasons, it doesn't change things. When you give real estate away, one of the things you give away is your basis. So that means that their acquisition price, even though you didn't charge them any money, is the same as your acquisition price, or $100,000. What's worse is if it's not their primary residence and it's their second home, and you're just thinking, oh, I'm going to put the kid's name on it while I'm alive just in case anything happens. Terrible advice. Don't ever do that. But if you put the house in your name and then they decide to sell it, they don't have that same primary residence exclusion of $250,000 or $500,000. They're going to pay property tax or capital gains tax from all the way back to your basis of $100,000. It is going to be more expensive for you if you put your children's name on the deed. Furthermore, if I go backwards to our property tax discussion, if you put your kid's name on it, they're going to actually pay a higher property tax value because there's a change in ownership. It's a transfer. And then when they sell it, they're going to pay more in capital gains because it's not their primary residence. Don't make these mistakes. They're really difficult to unwind. The assessor does not allow you to unring the bell to transfer the property back to mom and dad. They're like, sorry, you made the transfer. There's no going back. So it's a real problem when people start to do this. Do not start transferring property without good advice, and be sure to ask for advice. The other thing to know about property tax, and I think the next thing I'm going to tell you is by far the best piece of the tax code that there is. If there's anything good about the IRS tax code, it is step